This podcast is for informational purposes only and does not constitute financial advice. Consult with a qualified professional before making any investment decisions.
Welcome to the Wire Weekly Roundup. The week in real estate presented in digestible bites. Hold on while our AI hosts take us on another ride through this week's top real estate headlines.
Welcome, you savvy real estate enthusiasts and professionals, to another essential deep dive.
Great to be here.
If you're looking for that shortcut, that express lane to being truly well-informed on what's moving the needle in real estate right now, you are absolutely in the right place.
Exactly. We're aiming to cut through the noise for you.
We've got an incredible deep dive today, pulling from an extensive collection, over 70 articles, reports, videos, all from just this past week, June 16th to 23rd, 2025.
Yeah, it's a lot of ground to cover. It's really the essential intelligence you need, we think, to navigate what's happening out there.
Absolutely. And our mission, as always, is to distill the most critical insights.
Find those surprising facts, maybe some contradictions too.
And deliver truly actionable knowledge from this huge pool of information.
We're aiming for those aha moments,
Yeah.
keeping you engaged and hopefully equipped.
Exactly. Think of it as your weekly intelligence briefing, but without all the reading.
Right. Saves you on time.
So this week, we're diving into a really fascinating paradox that jumped out from the data.
Mm-hmm.
Builder confidence is, well, it's plummeting. Absolutely tanking.
Yeah, the numbers are pretty stark.
But, and here's the twist, we're seeing single-family construction loan volume actually grow.
Which seems completely counterintuitive.
Totally. So what's the story there? What does that tell us about the broader market?
It's a key question, and we're going to dig into it.
So to unpack that, we'll start with the big picture, the overarching macroeconomic climate.
Yep, rates, inflation, those global forces that, always find their way into our local markets.
Then we'll shift gears into the intricate dance of market supply and demand.
Looking at buyers, sellers, what's changing there?
And what's really happening with construction, especially that loan volume puzzle.
And we can't ignore the industry itself. It's evolving so rapidly right now.
Definitely. Profound changes. We'll look at AI. The impact there is fascinating, sometimes a bit daunting.
And the legal shifts, too, hitting brokerages pretty hard in some cases.
And finally, we'll wrap up with some really practical strategies, stuff you can actually use.
Whether you're a homeowner thinking about value or an investor trying to, navigate these complex waters.
It's a lot, but we're going to break it down. Help you spot the trends, understand the contradictions,
and pinpoint what truly matters for your strategy.
Okay, let's dive right in.
Let's do it.
Okay, let's unpack this. The Federal Reserve stance. They've maintained their interest rates, holding steady yet again.
Yeah, same message as before, really. June 18th, June 16th, consistent.
And sources like Real Estate News, CNBC, the mortgage reports, they're all emphasizing the economy's solid position.
Right, and the continuation of the Fed pause, as Ian Housing called it.
So what does that signal about their confidence, in the economy right now? And what does solid position really mean for real estate, for people like us?
Well, it's interesting. A sustained pause, especially when they use terms like solid position, generally signals a couple of things. First, it suggests the Fed believes inflation is either under control or, moving in the right direction.
Right.
And also that the economy is resilient enough to handle current rates without, tipping into a major slowdown. Chairman Powell's perspective, CNBC noted this, is quite telling. He basically said the best way to support housing is to restore price stability.
And keep the labor market strong.
Exactly.
Yeah.
That dual mandate again. Jobs and stable prices.
So for real estate, this sustained pause, it offers some predictability maybe.
Yeah, see, that's a key part of it, yeah. A degree of predictability lets the market kind of adjust, maybe reduces some volatility.
What we could use.
Definitely. But here's the aha moment, maybe. The Fed's solid position isn't exactly a green light for a housing boom.
No, far from it.
It's more like a yellow light for stability. Crucial for planning, sure, but it doesn't fix the affordability crunch.
Right. It implies things aren't collapsing, but they're not exactly roaring ahead either.
Precisely. A stable foundation, maybe, to plan from.
That stability is definitely something we've been craving. But even with the pause, we're already seeing some different opinions surface.
Oh, yeah.
Real Estate News reported, this was June 20th, that a Federal Reserve governor is actively pushing for July rate cuts, like saying, we could do this.
Wow. Okay, that's pretty direct.
Yeah, it feels like a significant deviation from the collective wait and see vibe.
Right.
How might this public advocacy, this kind of individual viewpoint, influence market expectations, investor sentiment?
That's a really powerful signal, actually.
Yeah.
Creates an interesting dynamic.
How so?
Well, when a governor publicly pushes for cuts, it clearly shows different views inside the Fed, which happens, but being so public is noteworthy.
Right.
It can definitely sway market expectations because investors, analysts, they latch onto these things.
Looking for any hint of a shift.
Exactly. It might lead some to believe cuts are coming sooner than they thought. And that alone can push down Treasury yields.
And maybe mortgage rates, even before the Fed acts.
Potentially, yeah. Or at least influence the sentiment. Buyers might feel more optimistic. Investors might start repositioning capital. But, there's a flip side. It adds uncertainty. What if the cuts don't happen?
Then you get disappointment, more volatility.
Right. It's a tricky balance for the Fed unified front versus diverse opinions, especially when those opinions move markets.
Yeah, billions of dollars potentially shifting. And speaking of mortgage rates, the mortgage reports showed these slight daily shifts all week.
Little ups and downs.
June 17th, 18th, 19th, 20th. Minor adjustments. Are these small, day-to-day fluctuations enough to really sway borrowers? Or is it just noise?
That's a good question. In isolation, probably not. These tiny shifts, fractions of a point.
Most people aren't watching that closely day to day.
Right. They're looking at the bigger trend, their own finances.
Right.
But what's crucial is the cumulative effect.
Okay.
If you see small downward moves consistently over days or weeks, it builds a narrative that rates are easing.
So it's the perception, the direction.
Exactly. It might incrementally improve affordability for someone right on the edge. But maybe more importantly, it affects sentiment.
If people think rates are trending down, maybe they jump in.
Could be. Or maybe they wait, hoping it goes lower. A slight upward trend might push fence sitters to act.
So it's subtle, but it can influence timing and psychology.
It definitely plays a role, even if the daily change itself is small.
Okay, here's where it gets really interesting, I think.
Lay it on me.
CNBC reported June 18th that mortgage demand actually dropped.
Even with rates easing a bit.
Exactly. Even as interest rates ease slightly, that seems totally counterintuitive, doesn't it?
It really does. You'd expect the opposite, or at least for demand to hold steady.
So what are we missing here? Why aren't buyers biting, especially if rates are slightly better and the Fed's paused? This feels like a key point.
It's the paradox of the moment, absolutely. And it's not just a blip, it's a huge signal.
Signaling what?
It strongly suggests factors beyond just the interest rate number are crushing buyer behavior and confidence. Affordability is the real choke point.
Oh, okay. So even if rates dip, prices are still high, inflation's still biting.
Precisely. The overall cost is still too much for many. High down payments, taxes, insurance. It all adds up.
And maybe just general economic uncertainty, people worried about jobs.
That's definitely part of it. Hesitation to make a huge commitment if you're feeling unsure about the future.
And maybe some buyers are just waiting, hoping for deeper cuts.
That too.
Oh.
It's a strategic wait and see. Why jump on a tiny dip if you think bigger ones are coming? Or if you hope prices might actually fall?
So it's a cocktail of affordability, uncertainty, and maybe strategic patience.
Yeah, it shows a fundamental lack of confidence in the immediate term, regardless of small rate changes. Crucial nuance.
Absolutely critical insight. And looking broader, we can't ignore global forces. Bigger Pockets mention the worrying economic fallout of the Iran conflict.
Right, geopolitical stuff.
How do tensions like that actually translate into anxiety in, say, the U.S. real estate market? Does it really affect investor confidence or capital flows here?
Oh, absolutely. Even seemingly distant tensions ripple through global finance, and real estate isn't immune.
How so? Like oil prices?
That's a big one. Conflict in a critical region like Iran can spike oil prices. Higher energy costs mean higher business costs, higher construction transport costs.
And less money in consumers' pockets.
Exactly. All dampening economic activity and potentially real estate demand.
And for investors.
Geopolitical risk often triggers a flight to safety. Capital moves out of things seen as riskier, maybe certain real estate sectors or international markets, and into safer assets like government bonds.
So less liquidity for real estate deals. harder to get financing or sell.
It can definitely tighten liquidity and impact valuations, yes.
Yeah.
It just underscores how interconnected everything is. Local markets feel global shocks.
It's not just conflicts either. Demographics, slower moving, but just as powerful.
Huge long-term impact.
CNBC reported China's population decline is directly hurting its property market. That feels like a major warning sign.
It's a stark example, yeah.
How do these macro demographic shifts affect real estate long term? And what could it mean for other aging populations, maybe even here?
It's fundamental. A shrinking or aging population, like in China, means less demand for new housing, period. More vacancies, downward pressure on prices, especially where growth was just assumed.
Affects residential, commercial, everything?
Everything. Fewer schools needed, maybe less vibrant retail, demand shifts towards different types of housing.
So for other aging nations?
It signals a critical trend. Less demand for big family homes over time, maybe more demand for senior living, smaller, accessible units.
So investors and developers need to adapt.
Completely. Shift from just building more to thinking about redevelopment, retrofitting, catering to older demographics. It's a huge structural shift, potentially overriding short-term cycles.
A demographic earthquake, as you said, not just today's rates, but tomorrow's population counts.
Exactly.
And thinking about future trends, CNBC also gave us 5 things we're watching in the stock market for the week ahead.
Indirect signals, maybe.
Right, not directly real estate, but often hints at investor sentiment or where capital might flow. What should we look for there?
Well, the stock market often leads broader economic sentiment.
Yeah.
So watching those key things gives us clues.
Like what?
If tech stocks are flying, maybe there's appetite for growth, maybe investment flows into prop tech.
Okay.
If defensive stocks are up, maybe investors are cautious, preferring stable income like certain REITs, or avoiding riskier development projects.
In capital allocation. A strong stock market could mean more money looking for diversification in real estate.
Or it could draw capital away if stock returns look better. It's about gauging the overall economic temperature and the flow of investment money, which eventually impacts real estate.
Gotcha. And on the tech front, specifically within real estate, Morgan Stanley expects significant savings for most REITs because of AI.
Yeah, CNBC had that video. It's happening now.
So this isn't just future talk. How is AI really changing things for, say, REITs? Improving efficiency, profits. What's it mean for investors?
It's potentially a huge shift, not just tweaking things. Significant savings for REITs. That's about transformation.
Oh, like property management.
Exactly. AI optimizing predictive maintenance, tenant screening, retention, analyzing huge data sets for optimal rents, predicting vacancies, managing energy use in big buildings.
You can do real cost cuts.
Substantial ones.
Yeah.
Which, for investors, means the underlying assets could become more profitable, maybe less volatile.
Better dividends, more stable growth.
That's the potential, yes. And AI can help REITs make smarter acquisitions, too, improving due diligence.
So investors looking at REITs need to consider their tech adoption now.
Absolutely. It's not just about occupancy rates anymore. How well are they integrating AI? That could be a major competitive advantage and driver of returns.
AI impacting the big players already. And shifting gears slightly, BiggerPockets talked about investors preparing for the big, beautiful bill tax changes.
Always something to watch.
It just highlights how crucial it is to stay updated on policy shifts. They hit the bottom line directly. What kinds of tax changes should investors be most worried about?
For investors, taxes are paramount. Changes can completely alter profitability.
Like capital gains.
That's a big one. Affects profit on sales. Changes to depreciation schedules, vital for rental income. Limits on deductions for mortgage interest, property taxes, operating expenses.
What about 1031 exchanges?
Huge potential impact there. Limiting those would drastically change portfolio growth strategies for many investors. Estate taxes, too, for passing assets down.
So the message is,
Tax planning isn't a once-a-year thing. Talk to your advisor constantly. Model scenarios. Adapt your strategy to the changing rules. It's about keeping your financial roadmap current.
makes sense. And one last quick look internationally, Canadian unemployment figures for May came out.
Right, from Canadian Real Estate Magazine.
While it's Canada, unemployment data is always a key barometer for spending and housing stability anywhere, right? General implications.
Totally fundamental. High unemployment means economic distress. Fewer people earning, fewer able to pay rent or mortgages.
Leads to delinquencies, foreclosures, softer demand.
Right. Conversely, low unemployment means a robust labor market. More people with capacity and confidence to rent or buy.
Supports demand and values.
Exactly. So while these figures are Canadian, the principle is universal. A healthy job market is the bedrock of a healthy housing market. It ensures qualified buyers and renters.
Okay, so that's the big economic picture. Now, with that backdrop, how are actual buyers and sellers navigating this? Let's zero in on those shifting market dynamics.
Yeah, the on-the-ground reality.
On the buyer side, Keeping Current Matters offered 3 reasons to buy a home this summer. What were those arguments? Do they actually hold water right now?
Well, articles like that aim to encourage buyers, right? So the reasons usually include things like easing competition.
Because some buyers are stepping back.
Exactly. Maybe more choice, fewer bidding wars.
Yeah.
Another common one is long-term appreciation. The idea that real estate gains value over time, so getting in now is still smart long-term.
And maybe the stability of current rates?
Yeah, relative stability, the Fed pause, giving some predictability compared to the heights we saw before.
Do they hold water, though?
For some buyers, yes. If you're financially stable, have a long time frame, aren't super rate sensitive, easing competition is real. Long-term appreciation is historically sound.
But
these reasons often glide over the huge affordability challenges many buyers, especially first-timers, are still facing.
exactly. Which brings us to down payments. Real Estate News reported they're dropping for the first time in nearly 2 years.
That is fascinating.
Especially paired with that Keeping Current Matters infographic about what buyers really need to know about down payments.
Right, demystifying the 20% myth, maybe.
So does this drop mean more accessibility for new buyers, or is it lenders shifting criteria because the market's tougher?
It's likely a bit of both, but it definitely signals increased accessibility, especially for first-time buyers.
How so?
It could mean lenders are offering more low-down payment loans, or maybe more buyers are using FHA, VA loans.
Okay.
It might also be a strategic move by the industry, lower the entry barrier, the down payment to try and re-engage buyers priced out.
Makes sense. But there's a downside.
Sure. Smaller down payment means a bigger loan, higher monthly payments, less initial equity. It helps with the upfront cash, but not the overall cost burden.
Right. And for those trying to get in, Geek Estate blog had strategies for maximizing savings, matching funds, rewards.
Yeah, leveraging employer programs, grants, special lender offers, often underused resources that can really help.
On the flip side, Realty Times pointed out common mistakes buyers make searching for their first home. What are some of those pitfalls?
Oh, the classic first-time buyer mistakes. Probably things like not getting pre-approved early so they don't know their real budget.
Falling for a house before doing due diligence inspections, neighborhood checks.
Right. Being too rigid on the wish list, making emotional decisions instead of rational financial ones.
And maybe underestimating the total cost beyond the mortgage.
Absolutely crucial. Taxes, insurance, maintenance, utilities. It all adds up. Avoiding these is about being prepared, pragmatic, patient.
Good advice. Now let's flip to sellers. Keeping Current Matters explored why more sellers are choosing to move even with today's rates.
Interesting counterpoint to buyer hesitation.
Yeah. What's motivating sellers if it means they might have to buy at a higher rate themselves?
It's often about personal or strategic factors outweighing the rate issue.
Like built-up equity.
That's a huge one. People sitting on tons of equity from the last few years have flexibility. They can absorb a higher rate on the next place, especially if upsizing or downsizing.
Object life changes.
Exactly. Job moves, growing families, empty nesters. For them, meeting those life needs is more important than waiting for rates to drop. Retirement, moving closer to family.
So it's not always purely financial.
Often deeply intertwined with life stages. For these sellers, the time is now, regardless of the rate environment they buy into next.
Life, not just logic. But while some are moving, the home building industry seems to be hitting major headwinds.
Oh yeah, the builder sentiment numbers are rough.
Souring, said Real Estate News, nearing pandemic lows, per CNBC, third lowest reading since 2012 from Ion Housing.
That sustained decline is a serious red flag.
It directly reflects rising costs, right? Materials, labor, plus softer demand and uncertainty.
Precisely. It's a direct reflection of all those challenges hitting them at once. Material costs eating margins, labor shortages driving up wages.
And fewer buyers ready to pull the trigger on new homes.
Right, so builders face huge uncertainty about selling homes profitably and quickly. Naturally, they pull back on starting new projects.
Which just makes the supply shortage worse long term.
Exactly, a vicious cycle. Fewer new homes built could eventually push up prices on existing homes, even if demand is softer now.
And the sentiment isn't just talk. It's translating into action or inaction.
We're seeing the slowdown in the construction data.
Yeah, home construction stalls as costs rise and demand softens, from real estate news. CNBC noted a slump in single-family starts. Ion Housing reported a sharp drop in multifamily reduction, dragging down overall starts.
And even permits weakened back in April.
Permits being the leading indicator.
Right. Fewer permits pulled means we can expect starts to stay slow in the coming months. It's a very consistent picture of a slowdown across the board.
Single-family, multifamily, the whole pipeline is tightening.
Which has long-term implications for availability and affordability.
Okay, so construction slowing, permits weakening, builder confidence in the dumps.
That's the picture.
But then Ion Housing reports June 20th that single-family construction loan volume grows.
Ah, yes. The paradox.
It feels like a major disconnect, a real contradiction. What is going on there? What should we make of this?
It really does raise an important question, and it gets to the heart of maybe a strategic shift, which is a key theme here. On the surface, it makes no sense. Slowdown, low confidence. Why are loans increasing?
Exactly.
Well, a few possibilities. Maybe builders aren't starting speculative projects right now.
The ones they hope someone will buy later.
Right. But maybe they are securing financing for larger, longer-term projects. Projects already planned, maybe with longer lead times.
Locking in capital now, hoping for better conditions later.
Could be. Or maybe demand for capital remains strong just for very specific viable developments. Prime locations, pre-sold homes.
So not broad building, but targeted projects still getting funded?
Possibly. It suggests a strategic accumulation of resources during a slowdown, rather than a direct link to immediate starts. Shoring up finances, focusing only on sure bets.
So more strategic positioning than a sign of an immediate building boom.
That's how I read it. It's about long-term planning by some players, even amidst the current gloom.
That makes sense. Planning for the future. And speaking of future hope, CNBC mentioned builder confidence might rebound if tariffs ease.
Right, highlighting those external factors.
How much do things like tariffs impact builders?
Significantly. Tariffs on imported materials, steel, aluminum, lumber, finished goods directly increase construction costs.
Which squeezes builder profits.
Or it gets passed on to buyers, making homes more expensive, hurting demand.
So if tariffs eased,
it would reduce those input costs, make projects more viable, maybe allow more competitive pricing. That could definitely boost builder confidence and encourage more starts.
Just shows how interconnected it all is, trade policy impacting housing supply.
Absolutely. It's not just rates and demographics.
Okay, moving beyond sales and construction, let's talk rentals and niche markets, a huge trend reported by Real Estate News. Renters now outnumber homeowners in many major suburbs.
That is a seismic shift. Huge.
What's driving that? Affordability, societal shifts, and what does it mean for urban planning, investment strategies?
It points directly to the persistent affordability crisis in homeownership.
Buying is just out of reach for too many, even in the suburbs.
Exactly. For a growing number, even those with good jobs, renting is the only option, even outside the city core. Suburbs used to be synonymous with owning.
So planning needs to adapt. More rental housing in suburbs.
Definitely. More density, maybe better transit, amenities catering to renters. It's a fundamental change.
And for investors.
It hugely elevates the importance of rental income. Multifamily, single-family rentals become even more attractive long-term investments.
Need to understand suburban renters now.
Their specific needs, yeah. This isn't just temporary. It feels like a structural change driven by economics and maybe lifestyle choices too. Rentals are central now.
And Geek Estate blog looked at the last 5 years from a rental perspective, emphasizing that growing importance of rental income streams.
Absolutely reinforces it. The last 5 years. Volatile sales market, but rental demand largely robust.
Driven by that homeownership affordability gap and demographics.
Right. So that reliable rental cash flow becomes incredibly attractive to investors, especially when things feel uncertain.
Suggests a shift towards yield-focused investing, income over just appreciation.
I think so. Prioritizing consistent income, which also means investors need to be really good at property management, tenant relations, because that is their income stream.
Building resilient portfolios through income.
Yeah.
Got it. Our Canadian sources also had some interesting rental insights.
Yeah. What stood out?
Co-living's growing role in urban housing. Also identifying specific Canadian rental hotspots beyond just national averages, and a look at the Manitoba rental market.
Those are great examples of the nuances. Co-living is a direct response to urban affordability and maybe a desire for community.
Innovative model for dense areas.
And finding hotspots underscores how crucial local analysis is. National data hides huge regional variations. Specific cities might boom while others stagnate.
And the Manitoba report gives that granular regional snapshot.
Vital for making informed decisions. Shows where demand really is, what specific solutions are working.
Okay, beyond residential rentals, we also saw activity at the high end and in active investment markets. World Property Journal reviewed super prime home sales data for Dubai. Still strong there.
Yeah, it's a fascinating contrast. Continued strength in ultra-luxury markets like Dubai, despite the broader slowdown.
Suggests that segment operates differently.
Very differently. Less about mortgage rates, more about global wealth flows, geopolitical stability, trophy assets.
Real estate as a store of value for the ultra-wealthy.
Exactly. It shows the market isn't monolithic. While average buyers struggle, the top end can remain quite active, relatively insulated from mainstream pressures.
And for the more active investors, World Property Journal also gave us the Q1 U.S. home flipping report. Sales, profit margins. What's that telling us?
That report is a key barometer for flippers. High volume suggests opportunities still exist, but the crucial metric is profit margins.
If margins are shrinking,
it means rising costs or softening prices are making it tougher. Signals a more challenging market for that strategy.
And Bigger Pockets noted investor home sales reached their highest share since 2001.
That's significant. Not just flipping, but investors overall having a huge growing presence, competing with home buyers, shaping market dynamics. It's a fundamental shift.
Powerful shift indeed. Okay, let's move to our third big theme. The real estate industry itself is in flux. Lawsuits, AI, adaptation.
A lot of pressure, a lot of change.
On the legal side, Real Estate News discussed the huge risk of litigation over private listings.
Yeah, pocket listings are under scrutiny.
That's the issue there. Transparency, antitrust.
Both. Regulators are concerned private listings limit exposure, potentially hurting sellers' prices, and creating an unfair advantage, excluding some buyers or agents.
Antitrust concerns if it reduces competition.
Exactly. So agents and brokers need to be incredibly careful now. Clear communication with clients about pros and cons, strict compliance, might have to rethink off-market deals.
Pushing for more transparency, equal access.
That's the direction things are heading.
And it's not just listings. Telemarketing lawsuits are piling up. Compass sued, Keller Williams sued again, both over unsolicited calls and texts.
Yeah, the big players are getting hit.
What does this mean for how brokerages operate, for agents trying to reach clients legally?
It signals a major tightening of consumer protection rules and enforcement. Brokerages have to rethink lead gen entirely.
Can't just blast out calls and texts anymore.
Not without huge legal and financial risk. For agents, it means extreme caution, adhering strictly to do not call lists, getting explicit consent, being transparent.
Shifts the focus from quantity to quality and compliance.
Absolutely. More inbound marketing, content, referrals, reputation, less cold outreach. Trust and permission are key now.
And adding to that legal pressure, Opendoor settled that lawsuit over its pricing tech for $39 million.
Right, scrutiny on the algorithms themselves.
What's the core issue? Fairness, transparency of the tech.
That's usually it. When algorithms make offers, there's an expectation of accuracy and equity. Lawsuits pop up when people feel disadvantaged or the process wasn't clear.
So the message for prop tech is,
innovation needs robust compliance and ethics baked in. Explainable AI, rigorous testing for fairness, preventing bias.
Legal risks aren't just for traditional practices anymore.
No, they extend right into the code and data models. Underscores that adapt or die theme adaptation now includes legal and ethical tech development.
Amidst all this, though, the brokerage beat from Real Estate News showed some are still growing. eXp Realty adding star power. KWCIRE expanding.
Exactly. It shows competitive strategies are still working for some. Attracting top agents, expanding into niche markets like commercial.
So refining the value proposition is key.
Absolutely. Better tech, better splits, training, specialized focus, whatever attracts and retains talent. It's an ongoing race, and strategic adaptation is paying off for some.
And a crucial part of that adaptation, according to Real Estate News, is leaning into diversity. How does diversity make a brokerage truly future-proof?
That's such an important point. It's not just social good, it's a strategic business advantage.
How so? Better client understanding.
Definitely. A diverse team connects more authentically with today's diverse home buyers and sellers. Different backgrounds, languages, cultural insights expand market reach.
And innovation.
Yes. Varied perspectives lead to more creative solutions, better adaptation, prevents groupthink.
Plus attracting talent.
For sure. Top agents, especially younger ones, want inclusive workplaces. So diversity helps recruitment and retention. It makes a brokerage more resilient, adaptable, relevant.
Makes sense. A business imperative. On another note, evolving service models, we see low-fee brokers presented as a viable option.
Right, appealing to cost-conscious sellers.
But that contrasts with the idea of why most sellers hire real estate agents today, presumably for full service.
Exactly. It's that dichotomy.
So what truly drives a seller's choice? Cost savings or the perceived value of comprehensive service, especially now?
It depends on the seller. Low fee appeals if cost is everything and they feel they can handle parts themselves.
But full service agents offer
Expertise in pricing, marketing, negotiation, legalities, managing the stress, especially in a complex market. That perceived value, market insights, network access, problem solving is huge for many.
So agents need to really define their unique value.
Critically important now. Clearly articulate what you bring beyond just the listing. Negotiation skills, market knowledge, ensuring a smooth, secure deal. Justifying the fee with better outcomes.
Which brings us to the elephant in the room. AI Real Estate News said AI agents are coming.
The buzz is definitely loud.
So this AI takeover, how close are we really? Are AI agents replacing humans? What should people prepare for?
It's less a sudden takeover, more a gradual, profound redefinition of roles.
Okay, so AI is taking over some tasks.
Oh yeah. Lead qualification AI can sift through inquiries way faster. Data analysis, market trends, values, optimizing marketing, initial client interaction chatbots handling basic questions, scheduling.
Freeing up human agents from repetitive stuff.
Next sec, from admin, data-heavy tasks, OUT. AI isn't equipped yet, probably won't be for a long time, to replicate the core human elements.
Complex negotiation, empathy, trust building.
Precisely. Those nuanced skills remain human strengths, so listeners should prepare not for displacement, but transformation.
Learning to leverage AI tools.
Yes. Use AI to boost efficiency, provide better service, and focus human effort on high-value relationship parts of the job. Remember the read savings. AI's impact is broad. It's about working with AI.
That's a more realistic, maybe reassuring outlook. And beyond AI agents, other tech keeps evolving. ReChat hit 10 years, launched a new search site.
Just PropTech is maturing, refining solutions. New search sites push for better user experience, data, features.
And World Property Journal mentioned expanding global property search and listings.
Another key trend, more interconnected digital world. Easier for investors, buyers to find properties anywhere. Facilitates cross-border deals, increases transparency.
Opportunities for agents to expand reach, too.
Definitely. But as the BC short-term rental issues show, innovation often creates friction with regulations.
Right. Tech models clash with zoning, taxes.
So huge opportunities, but new regulatory hurdles to navigate alongside them.
Okay, let's shift to our final section. Practical home ownership and smart investment strategies from the week's sources.
Actionable stuff.
For homeowners, Realty Times was full of tips. DIY appliance repairs, knowing what you can do and what you shouldn't.
Smart. Saves money, prevents bigger problems.
Tips for a fresh feel, decluttering without dread, renovating with kids.
All about enhancing the living space, making it more enjoyable, which adds value too.
Making small bathrooms look bigger, backyards feel like resorts.
Yeah.
Maximizing what you have.
Very practical ways to invest in comfort and function, boosting long-term appeal.
And for maximizing value when selling, strategic timing for interior painting, busy season versus bargain season.
Clever. Save money painting off-season, have it fresh for peak buyer traffic.
And Zillow highlighted specific paint colors that can boost sale price.
Yeah, data shows certain colors, often neutrals, appeal wider, make spaces feel bigger, and actually lead to higher offers. Smart, targeted improvements.
Plus, the Canadian piece on green priorities shows sustainability influencing renovations too, another value booster for some buyers.
Definitely a growing trend.
Now, pivoting to investment strategies, financing options. Bigger Pockets explored DSCR loans for refinancing.
Crucial tool for investors. DSCR loans look at the property's income, not just personal income.
Good for pulling cash out, freeing up personal DTI.
Exactly. Offers flexibility for portfolio growth, less reliance on personal income docs.
And they also compared hard money loans versus bank loans.
Right. Hard money is about speed and flexibility, usually for short-term projects like flips or distressed properties where banks are too slow or won't lend.
But the trade-off is higher costs.
Much higher rates and fees, yeah. So best for quick, high ROI deals where speed is essential. Understanding these different tools lets investors tailor financing.
And once financed, it's about building the portfolio and managing risk. Bigger Pockets stressed great underwriting to protect investments. What does that actually look like?
Great underwriting is the bedrock, meticulously evaluating everything before buying.
Rigorous financial analysis. Stress testing cash flow.
Yes. Projecting realistic income expenses, testing against worst-case scenarios, higher vacancies, lower rents, vetting tenants thoroughly, assessing property condition accurately.
Understanding local market dynamics, legal risks.
All of it. Being disciplined, conservative in assumptions, having contingency plans. It's how you avoid overpaying and build a portfolio that can actually withstand downturns.
Makes sense. Bigger Pockets also gave tangible strategies. Path to 5 short-term rentals in 5 years.
A focused, step-by-step niche strategy, market research, management systems, knowing local rules, deliberate growth.
And building a $10 MIBOR INGAR-R portfolio using the SCALE framework.
That's an advanced, systematic approach.
Yeah.
BRR, buy, rehab, rent, refinance, repeat is powerful for recycling capital. The SCALE framework likely structures that process for massive growth.
Providing a roadmap for big goals.
Exactly. Turns ambition into manageable steps.
History lessons seem important too. Bigger Pockets advise revisiting the 2008 financial crisis. Key takeaways for today.
Oh, absolutely essential. 2008 teaches about the dangers of excessive leverage, speculative lending.
When loans were too easy.
Right, fueling a bubble. It also highlights needing to understand market fundamentals, not just chasing appreciation.
Diversification is key too, right?
Critically, don't put all eggs in one basket. And the crisis showed how broader shocks hit real estate, how quickly liquidity vanishes.
But also resilience long-term, opportunities in downturns.
Yes, for those positioned well. Underscores needing cash reserves, sound planning, a long view.
And navigating this inflationary environment, Mercer's Olaoluwagunga on CNBC discussed focusing on real estate sector investing. How do strategies adjust for inflation?
Real estate is often seen as a good inflation hedge. Property values, rents tend to rise with inflation.
Protecting purchasing power.
So strategies include focusing on properties with short leases or frequent rent adjustments, short-term rentals, certain commercial leases to capture rising costs quickly.
Investing in essential or hard-to-replicate properties.
You know, like industrials, some multifamily, where replacement cost rises with inflation, focusing on strong cash flow that keeps pace.
And for Canadians, knowing how REITs are taxed is crucial for after-tax returns, especially with inflation.
Absolutely. Tax implications are vital everywhere.
Okay, wrapping up the practical side with some consumer and community advice. Realty Times clarified HOA CC&Rs versus rules and regulations.
Super common confusion. CC&Rs are foundational, legally binding, hard to change. Define core rights, obligations, architecture, use.
Recorded with the deed.
Right. Rules and regs are more specific, operational, easier to change by the board. Implement the CC&Rs like pet leash rules under a general pet allowance. Understanding the difference avoids conflicts.
And for sellers, Realty Times had basic but essential tips. Real estate photography.
Fundamental. Good photos are the first impression. Bad ones kill interest. Lighting, decluttering, pro-editing matter.
And keeping for sale properties safe.
Paramount.
Yeah.
Securing entries, removing valuables, alarms, lighting, protecting the asset during showings.
They also touched on luxury apartments, condo renovations, diverse living situations.
Right. Optimizing different kinds of spaces.
And we got those regional snapshots, Orlando sales prices, Toronto GTA market data, crucial local context.
Puts the broader trends into perspective for specific areas.
Wow, what a comprehensive deep dive we've had this week.
We covered a lot of ground.
Seriously, unpacked everything from the Fed's moves and mortgage demand shifts
to that construction loan paradox, the rise of AI agents.
Evolving legal pressures and tons of practical tips for homeowners and investors.
Yeah, and if you try to synthesize all of that, pull the threads together.
What's the big takeaway?
The unifying insight seems clear. This isn't just a normal market cycle adjustment. Real estate is undergoing a profound structural transformation.
How so?
It's the convergence. Persistent monetary policy realities, big demographic shifts like renters outnumbering owners in suburbs now, and disruptive tech, especially AI.
Meaning the old rules don't quite apply anymore.
The traditional rule book is being fundamentally rewritten. It's not just a tough market, it's a rapidly evolving one.
Okay. So what does this all mean? The actionable takeaway for you, our listener, has to be
proactive adaptation. Success now depends less on just riding waves, more on actively adapting.
Which means
cultivating sharp awareness of economic signals, global forces, beyond just rates. Aggressively embracing tech like AI, understanding the opportunities and the complexities, legal and ethical,
Tailoring strategies constantly.
to changing behaviors of buyers, sellers, renters, and maybe most importantly, prioritizing continuous learning. Agile adoption of new financing, new investment frameworks. That's key to staying competitive and profitable.
So adaptation, awareness, agility.
Which really raises an important question for everyone in this space.
Go on.
Given this accelerating tech integration, these profound shifts in demographics and market behavior, how will you redefine your strategies, your value proposition, your whole approach? How will you not just survive, but actually thrive and lead in the real estate market of tomorrow?
That is a powerful question to leave you with, and definitely one worth pondering. Thank you so much for joining us on this deep dive.
Hope it was valuable.
We certainly hope you found these insights empowering.
Until next time.
We look forward to our next deep dive together.
If you're interested in your own personalized edition of The Wire, please visit us at thewire.fm/custom. We offer market-specific podcasts with all the latest real estate news and market analysis delivered to you weekly or monthly. Own your market with a personalized edition of The Wire, The Week in Real Estate. Thank you for listening.